Hello and welcome to Money Matters because life matters more. We live in uncertain times, and today we're speaking to that with Peter Joers. Peter has more than 30 years of experience in the markets as an investor. He's one of the people I most respect for his thoughtful, pragmatic, and long view on money. Peter has played significant leadership roles at Bank of America and Montgomery Securities. He worked at Bridgewater Associates and is currently a partner and co-founder at Abos Capital Management. Today, we're discussing his thoughts about money in times of uncertainty. Peter, it is a pleasure to have you on the show.
Great to be here with you today, Peter.
Thank you. I'm curious, we live in uncertain times, but there's always some uncertainty. I'm curious, does this time in the world feel more uncertain to you than others, or is this just business as usual? I know, we're speaking of tariffs, technology change, economic changes. Is this business as usual, or is there heightened uncertainty today?
Well, when I look back across my career and, I try to remember what things were like at different periods, I think the answer I come back with, it's always felt uncertain. We're more aware of the current uncertainties. You mentioned some of them: tariffs, wars, the rise of AI. But I don't know that it is. And I think that word gets used a lot, uncertainty, when we're talking about investment markets. But I don't recall a period where they were ever certain. As a matter of fact, I think once you get a consensus that they are certain, you're normally setting yourself up for a big surprise. But there is a lot, right? There's a lot changed. You could argue that the peace dividend is gone. The rise of AI, there is a wide cone of expectations in terms of implications on markets and on our lives and social issues. And then I would say tariffs and the way the administration turns these on and off, and it feels random. That seems to me, more uncertain than usual.
Right. You've been an investor through the dot-com crash, the mortgage collapse, through the pandemic, through the recent banking troubles in 2023. Do you think that life ahead looks like the similar number of, let's say, black swan events, and that's just you don't know when the next one's coming, but there will be, or more black swan events because things are moving faster?
I don't think you can know.
Yeah.
We can talk about them but I don't think that the thing that we're all talking about more now, that certainly than we were a couple 3 years ago, ever since we got exposed to ChatGPT, of course, is AI.
Right.
And what are the implications? There is, I think you and I were sharing an article recently talking about the potential for a massive boom in productivity, right? But, one thing to consider is that productivity, there's no tight link between productivity and equity prices, right? And if I think about past times, right, the internet boom, what you saw was an enormous destruction of capital. Thinking about all of the internet infrastructure companies, from peak valuations, we could probably find $1 trillion just going through the Lucent and the Nortels and the Ciscos of the world. I think about the shale oil boom, right? I mean, we discovered another Saudi Arabia here in the United States, and the numbers I've seen suggest since, let's call it 2010, that the industry has net destroyed about $250 billion in capital. So now consumers benefited from cheaper electricity. It's wonderful, right? And I think you could say the same thing about AI. To whom will the benefits accrue? To society more broadly, to equity holders, to labor. It's hard to know. It's very hard to know, and it's probably better to say it's impossible to know.
Right.
We like to talk about a term my partner likes to use, which is, he calls it sort of Rip Van Winkle test, which is, you want the portfolio that you're comfortable with, saying, look, I'm going to go to sleep and I'm going to wake up 30 years from now and I'm going to be comfortable with that portfolio. And if you don't feel you have that portfolio, it's probably a sign that you're taking on too much risk.
Mm-hmm.
I worked at Bridgewater, worked for Ray Dalio, and one of his maxims about investing is, he says the one thing he knows is that he's going to be wrong all the time. Going to be wrong all the time. As a matter of fact, the largest hedge fund in the world, and they're trying to be better. Call it 55% of the time that they're hoping to be right.
Right.
They know they're going to be wrong a whole lot, and so when you know that, you think about, all right, so what I want to do is I want to build a portfolio that can do well in all scenarios. Right. So rather than trying to guess, okay, the Ukraine war started, and so what's that going to do for global growth, and what's that going to do for inflation? I think most people probably would have been wrong about that. Right. It's here comes the end of the peace dividend. I think stocks are up about 50% since that time. That's been just a few years.
Right.
And it hasn't played out like a lot of people would have imagined. The war hasn't played out as a lot of people had imagined, and certainly the economic impacts haven't either.
Right. Yes, that's true. It's interesting because I feel like as a investor, I have often thought I'm a big believer in broad diversification. And to me, I've largely placed my faith and had success with broad market ETFs. And I think there's lots of research about the efficacy of those, and have generally been all in on the stock market and thought broad market ETFs got you covered. Well, I feel, given the uncertainty now, that just being in on the stock market, I wonder if that's sufficient. And I think about real estate, commodities, and the broader breadth. And in part, that's in my own thinking about uncertainty and just an increasing appreciation. Okay, uncertainty could look like the events we've had in the past. And generally, stock market does well, S&P 500's at an all-time high or thereabouts. But also envisioning, okay, it's not, the future could look different. And I'm thinking more in terms of different classes now than I have in the past. I'm curious if your thinking on that has evolved.
Sure. So, I think you're asking, maybe the most important question right now. And I'm trying to remember how you put it. Let me just start first of all with ETFs. They're fabulous. What a great tool those are. By the way, there's plenty of real bad ones, but yes, good way of building a diversified portfolio from liquid assets. So big fan of those. But yes, in terms of stock market, now one of the things you didn't say, but I think it was implied, was the U.S. stock market. I think most people, when they say the stock market, at least here in the country, they are talking about the U.S. stock market. And I think we believe it's really important that you have global diversification. And I'll hit on a few reasons why we think that matters now more than it has for quite a while. I'll start with a story that my partner likes to tell. When we were at Bridgewater, one of the things that he was responsible for doing was heading up to Harvard Business School and helping interview candidates. And one of the questions he would lead with was, well, why do equities make money in the long run? And the answer was almost universally economic growth. And he'd say, well, is it possible to make money in equities if there is no growth? And the answer was pretty universally no, you couldn't do that. And so what he would do is he would transition to this story of a lemonade stand in Detroit. And the business model was simple. You buy lemonade at the store for a dime, you sell it for a quarter on the street corner, margins are fixed. Unfortunately, when he was doing those interviews, Detroit was shrinking. Of course, that's changed. But he said, the lemonade stand is going to sell fewer and fewer glasses every year, maybe 1,000 in year one, 950, 900, et cetera. And so the next question was, well, would you buy a part of this business? And this is where he said, you would see the answers diverge into all kinds of areas. But the savvy candidates realized that the only answer was depends on the price, right? That's the punchline. And so if you pay very little for this business, it can generate a great return. And if you pay too much for it, your long-term returns are going to be disappointing. And you can sort of see where I'm going with this. Is this what we're seeing? This is in our view here in the United States, where we have the best companies in the world. Hands down. I mean, companies like NVIDIA, Microsoft, these are the best companies in the world, the best managed. They have moats around their business. They're wonderful. But what are you paying for them? And we have this chart that you can Google search and you can find any number of these. This one that we happen to have had was something that Northern Trust put out a few years ago. And they used a 20-year sample comparing real GDP growth versus real equity returns across the 46 countries in the MSCI World Index. And what you saw was there is zero relationship between the growth rate of an economy and the return on the equity market. Because it's not growth that matters, it's what you paid for that growth.
Right.
And so when you look at and I think I've got some numbers here. Let me see if I can find them. But if you look at what is priced into the United States market versus the rest of the world, it's very expensive. And it's been a combination of things that have turbocharged returns. You've had federal deficit spending, right? So it's spending that the companies don't have to fund. So we've had a lot of that. We have dis-saving by consumers, which is probably a topic near and dear to your heart. And so operating leverage, national dis-saving drive record margins, and so you end up with stocks that are priced for perfection. And now many of those key supports are fading, right? Globalization is moving in the other direction. Decades of disinflation, which allowed for a lot of easy money policies, can't do that anymore, right? Now that inflation has emerged. So what really matters is what you pay for it. And I remember in my career advising pension funds, and this is going back, 15 years, and we would be in front of boards and in front of CIOs, and they'd say, well, everybody knows that emerging markets are going to grow, the economies are going to grow faster than the United States. By the way, everybody does not know that. But I would concede the point because they have all of these advantages and cheaper labor and, access to natural resources. Okay. So that's where we want to have our money. Well, the answer that we gave them at the time was, yeah, but what's priced in? And they were priced in. I mean, right? You can look at the Chinese miracle. There's a number of things that went through that. The Chinese economic miracle is like something the world's never seen, but you haven't made any money in Chinese equities over that period. So, Yes, I think it's very important to be globally diversified. I think that you want to be diversified by asset class as well, and also have some currency diversification. And there's a number of ways that you can do that. Uh, but yes, just a U.S. stock portfolio is you're not getting the most out of diversification.
Right. For someone who, let's say they're 30 years old and they have a windfall, maybe they sold a house, they have a big bonus from work, not a life-changing windfall, but a significant windfall.
Mm-hmm.
Would you suggest markets are pretty, well, the S&P is pretty high right now, but generally, yeah, markets are generally doing well. Would you put that all to work right now? Or would you, and I guess the brass tacks, what would you, for a 30-year-old who had a 5-6 figure windfall, how would you put that to work?
Sure. So answer that in a couple of ways. The only real good argument for waiting to put the money to work or staggering it in is you're managing your own emotions, and that's a legitimate thing, right? But if you put all that money to work, and you wake up a week later and you've lost 4%, how are you going to feel about that? And do you run the risk that you will react in such a way that will hurt your ability to generate good long-term returns? So that's a question you have to ask yourself. But otherwise, when we know we can't time markets,
right,
we know we would want to be fully invested day one.
Right.
Okay. Now let's talk about valuations and that part of it. Again, that's timing. And I can tell you that valuations are very good, very dependable over the long term, and all but useless over the next year. Right? They don't tell you much of anything. Right? You can almost think of it as somebody who's an excellent card counter. Right? One of the top. It tells you very little about their odds of making money on the next 1 hand, 2 hands, 3 hands, 5 hands. But over 1,000 hands, yes, it's you know that you have an edge. So that's not that's something to think about. But I think let's talk a little bit more though about valuations, which is if you are building a diversified portfolio across asset classes and across regions, then really all you're doing when you think about timing and valuation is you're really asking a question about risk premiums, right? And when we look across the globe and across all these asset classes, we say, no, they seem fairly priced relative to where cash is. When I look at the returns I can get on cash, treasury bills, and its expected returns built into broad asset classes, it looks like a pretty decent time to invest. Now, U.S. stocks stand out as very expensive based on just about, I mean, we're right in the, all this is debatable, but we're right there in sort of internet bubble, 1929. I mean, we're a lot of different metrics, a lot of ways you can cut it. A lot of real smart people that we respect who research this, and they come up with slightly different ways of doing it, but that's what it looks like. And like I said, that doesn't really tell you anything about what's going to happen over the next year or two, but it's pretty dependable over time.
Right. I love hearing how you think because I've realized in this conversation, my view is generally broad diversification. As I mentioned, ETFs, put it down, forget it, check on it maybe annually, sometimes quarterly. Our two boys, one's in high school, one's in middle school, are both interested to get their hands wet investing. And so we have accounts where they have put some of their savings to work. And I, having this conversation, I've just reflected on the differences in how I think about it and how I'm talking to them about it. Because I think a broad market ETF that you check once a year is pretty boring for a high school kid who's learning to invest. And so I've been helping our older son think about stocks, and I knew some of the lessons were coming off well when some of his stocks plunged a few months ago. And he called and he said, I wish I had more money to put to work because tuna is cheap and I want to buy more tuna. But I also think I'm not necessarily teaching him the boring lessons of how capital appreciates steadily through broad diversification. Curious if you have any wisdom for how to help young adults and kids kids especially thinking about investing and having something where they feel like they can roll up their sleeves and be in it, but also knowing that I don't, for success for our family, I don't think is building a day trader.
Right. So let me first say, the way you're doing it, right, opening your statements at most once a quarter or maybe once a year, I think puts you at a real advantage. I mean, one of the questions I ask people, I'd say, ask your advisor, what's the point of this statement? Right? What am I supposed to get out of this? And you've seen from brokerage firms, right? They've gotten more complicated and more data, but more is not more, right? I mean, I'd like to know my money is still there, but what are you going to action on? What would be the things that would cause you to say, I need to make a change? You should have that list of things before you open the statement. Otherwise, what you're doing is you're setting up something to react to, which is, not what you want to have happen.
Right.
The question about educating kids is a great one. It's a subject I care a lot about, but I admit that I haven't taken the time to do something about it in a meaningful way. I was for a while, I served for a couple of years on the financial literacy public-private partnership here in Washington State, and care very much about getting financial education into the schools. And by the way, it's starting to change. I mean, this was 20 years ago when I was doing it. It was frustrating because there was plenty of good content. That wasn't the issue. It was getting shelf space. But it seems to be changing nationally, recognition that we need more financial education. But one of the things that has always just driven me crazy is that you see in schools and a lot of education is around stock picking contests, right? And you think, well, wait a minute, we live in a world of ETFs like you do, right? I mean, how would stock picking help you in a reasonable way to be a better investor? Matter of fact, if anything, it seems to me it has the potential to encourage a lot of bad behavior. And if anything, it has the ability to maybe even scare you away from investing, right? So let me give you an example. I'm making this up here, but you just described at the beginning what's good investing, right? Put it away, right? The Rip Van Winkle portfolio. Is it still there? Sure. Buy and hold, be broadly diversified. It is boring. That is the lesson. That is the lesson of the best investors, right? That the people that have successful outcomes recognize they don't turn things over. They don't pay a lot of taxes. They don't, right? They understand compounding, right? That's the thing you want to teach them. So I'm gonna make up an analogy here. Already it doesn't feel good, but it's like wouldn't you want to put your kid in a car and they can see, hey, look, I went a half a mile down the road and that only took me 30 seconds and I got to my destination and wasn't that great. But instead, the stock picking, it's like dropping them in a Formula One car in the middle of the race where they have, you're going to go buy a stock, right? And by the way, the games are always messed up because once you understand the games, you realize, just buy the most volatile thing because they're normally winner take all. But you're going to drop them in and we're going to buy a single stock or two or three. And so we're going to have a portfolio that's very volatile. And so there's the good potential that they're going to learn one of two bad lessons. Either, wow, that was easy. I was up 50% in 6 months. I should have used leverage. I need to do a lot more of this. That's a bad lesson. Or they lose half of their trading portfolio, and once bitten, twice shy. I'm not doing this again. So, what I think we need to be doing is teaching about how to dependably grow your wealth, how compounding works. I think we need to be teaching more about saving, what deferring consumption looks like, how that can be so powerful in terms of helping you meet your goals. But, it is a very small minority of people who are going to go on and be stock analysts, let's say, and that's not the best place for them to learn. It's probably a lot better for them to get a liberal arts education and learn how to think independently, and then get dropped into a training program or something at an older age.
That makes a lot of sense. Thanks, Peter. I love it. It actually makes me think I should reorient my work with our boys around portfolio construction, portfolio diversification, and then show them how, let's run a couple portfolios this year and see, okay, this one might be 0.5% better than that one. If the international is slightly more, slightly less, and then teach them why that 0.5% matters, and let's carry that 0.5% over 30 years. So it gives me a whole new way to think about, because I think what is interesting for young adults is to have a chance to pull some levers and play with levers. But I think that the portfolio balancing in the margins and thinking about showing how the margins matter is probably way more constructive than figuring out if they should buy shares of the stock that's in the headlines.
Yes. And so then if I was trying to teach them about diversification, just on the fly here, I'm thinking about, well, how do I make that kind of sexy?
Yes.
Right. I think one thing is just showing the math. Ray Dalio is fond of saying that the biggest mistake most investors make is they're all looking for the best investment. But if I just have a handful of decent investments, but they're all dependably unrelated, the math of that is I get this machine that's so much more efficient, which I can use to go farther, right? Or to save money, right? I can use it for higher return, leverage, or I can use it for a smoother ride, right? And then what is the value of that smoother ride? I think another way you could teach diversification that would be interesting to them, maybe any of your kids who are more history buffs, but where you show them the how any one asset class can underperform longer than your investing career, right? Japanese stocks, right? It takes, don't quote me, whatever, 25, 30 years to see a new high, right? And they start getting their head around it, and currencies and how these are not one-offs. These happen all the time, and I'm cherry picking this to make the case, but go back 25 years, maybe a little bit more. I'll really cherry pick it. I'll go back to January of 99. We all know stocks are the best. Well, how have U.S. stocks done over that period of time, would you guess, versus gold? And gold is up 10.5 times over that period of time. Okay, 26 years. Stocks are, I don't know, 6 times? Maybe we have to go look, but not even close. Now, do I think over long periods of time that stocks should generate higher returns than gold? Absolutely. Absolutely they should. But what's long?
Right.
And I think the more you can steep them in that history, understanding how difficult it is to predict. You don't need to predict all the risk that comes with predicting and what can happen. Then maybe you can make diversifying feel more tactile, more engaging, and more interesting.
Yes. Yes. I love that. That is a great idea. We were in Japan this spring, and I actually had that conversation with our family because if you you were working 30 years ago in Japan and putting all your investment funds in a broad market Japanese fund, 30 years later, you'd be about where you were. And that's not even addressing inflation. And it's incredibly humbling. I think that was one of the things that got me thinking, I need to consider diversification from a different perspective, because that, I know the Japanese economy has been flat, but to just go there and visit and to realize, holy smokes, this market has been pinned here for so long.
And you go over now and it's an economy vacation. I remember my father was doing business in Japan in the 80s, and he would come back with these stories. And, he had one where that he said the grapes, and I don't know if that was in the hotel or the market and I'm sure they'd been flown in from somewhere. And so we'll just assume they're the best grapes that you could ever buy. But this was in the 80s. He says, yeah, it worked out to $1 a grape. Right. This was in the 80s. Yes. Right. So we're, what's that today? I don't know, but it can happen. Right. And Japan was the thing. I mean, right. You think about the movies in the culture at that time. They were buying Rockefeller Plaza. They were buying Pebble Beach, and they've got the dominant model. And that was the consensus, and that was the fear, and people overlooked the fact that they had a demographic problem, that prices were absurd, and that they lived on a rock in the middle of the Pacific with no natural resources. Right? That those things got ignored, and there's a tendency for that to happen in markets where pricing changes drive forecasting.
Right.
It shouldn't be that way, but it's like, okay, now how do I justify this? And that's what it feels like to us in the United States. Like I said, we have the best companies in the world. Of that, there is no debate. And we can talk about all the challenges that other parts of the world are facing. And for many of the countries, they're significant. Right. But the hurdle rate for them to generate good returns, in their economic performance hurdle rate is so much lower.
Right. Yeah. Yeah. No, a lot of that's fully priced in or more in the U.S. market. Right. Mm-hmm. I remember a conversation with one of your colleagues about crypto specifically, and just reflections that for governments, currencies and armies are two significant levers of control, and it's unlikely that governments will readily give up either. Any thoughts on where, not so much on currency investments specifically, but just where you think crypto might, scenarios for where crypto could go from here?
Yeah, I don't, I have very little confidence in my ability to forecast that. But yes, that is our view, is that the idea that Bitcoin, that the U.S. government will allow Bitcoin to replace the U.S. dollar, that is, in our view, far-fetched, right? I mean, you can think about how we moved off the gold standard. Why did we move off the gold standard? Because we wanted to be able to control the flow of money and control our economy, right? We don't want our economy tied to something that we can't create more of, right? So we get a recession and we can't turn the knobs. So that's why we disconnected from gold, right? And so the same thing, I think, Bitcoin, to me, the best comparison is a digital gold,
Mm-hmm.
right? And we can think about the advantages it has over gold. I can think of a number of them, and I can think of disadvantages as well. But we're not going to go back on the gold standard. I like to think that's unlikely. Um, Long term, these countries are going to want to have fiat currencies, and that's not a power that they are, in my opinion, going to be willing to give up. Now, we're nowhere close to that, right? You look at the total market cap of Bitcoin, and I mean, it's very small. And people who are evangelists will use that as an argument for why you want to own some.
Right.
Because if you did believe that it was going to replace fiat currencies and that was going to be allowed, then you say, "Wow, we've got a whole lot of upside here." Right. But I think what I tell people is you just really ask yourself with any asset class, right? Do you like it because it's gone up, right? And is it FOMO, or do you like the investment thesis?
Right.
Would you have done if it had not gone up in the last X years, would you be doing the same amount of work wrestling with it and trying to figure out if it's the future? So I don't know. I think there'll be a lot of money made and a lot of money lost between now and many years from now, but I'm not able to get my head around the idea that Bitcoin or any other cryptocurrency is going to replace the fiat currency of developed markets.
Yep. That makes sense. I would agree. We've been talking about investing, and you've mentioned a few times cash flow and spending, and I remember a conversation with you a few years ago, talking about cash flow riddles with clients you've worked with. I think sometimes people think that, okay, I need to think about cash flow if I'm starting out and my accounts are empty, or if I'm in debt and I need to get out of debt, and that is all true. I think that sometimes people forget that cash flow can be actually relevant at all stages in the economic journey. And just curious if you have any anecdotes or perspective on that, on the importance of staying on top of cash flow.
Yeah, right. It's important as an individual. It's important for a business to understand let's start with what your liabilities are, right? What's your cash that goes out and that has to go out, and the risk if you're not able to meet those liabilities. And then understanding your own cash flow and the dependability of it. And then when we talk about valuation, it's funny, we were talking earlier about educating kids and stock picking games. I had the thought at that moment that I would be more a fan of those if we were teaching young people how the value of any asset is just a function of discounting its future cash flows.
Right.
If we were doing that exercise, I think that's very valuable, right? Cash is the anchor ultimately, right? And you think about any number of the sort of super investors from the previous era. I'm thinking about people like John Malone, who was somebody that part of a group of people that recognized early on that cash flow was what mattered. Wasn't earnings. It was how much cash will this business generate, and what will the growth of that cash look like. But ultimately, that's the bedrock of all investments.
Right. And we see at Tiller, we see people who we've helped with their get on top of their cash flow. And as I say, there are those success stories where someone says, I've finally paid off $10,000 of credit card debt. I can't tell you how that's changed how I feel waking up every morning. But I think there are others who have significant bank accounts, significant assets, and significant cash flow, and feel totally out of control and are spending way faster than is sustainable. And, and we see stories of people who have come across great wealth and have seen it vanish because their cash flow far exceeded the fortune that they had amassed. And I think that at every stage in the journey, I think cash flow is empowering, because if you're putting that money to work, and if you're spending below your means, you're creating a sustainable future where those assets are going to grow. And there are times in life where we need to harvest and we need to pull, and our assets may be, but we should be well aware when we're doing that and do it consciously, and not feel like we're in a place where we don't know what's going on and we're not really paying attention, and something we've worked really hard for starts to disappear under our feet.
Absolutely. Now, I'll also point out, maybe a smaller point, that is that you want to understand cash flow, and you don't want to, sometimes people can take it too far in the investing world. So they will, a good example is they'll look at dividends. They'll see a company that has been paying recently some larger dividends. Okay. They say, oh, that's great. They pencil in this. I'm going to get, 8% yield. I understand cash. I get that quarterly. I get 2% a quarter. But that ends up, for a lot of people, it's sort of, it masks the underlying business.
Right.
Right. If the underlying business is losing money and they're paying out 8%, they're not going to be able to do that forever.
Right.
Right. And so, I'll see people sometimes bucket, which I think the wrong way, which is say, well, okay, these are my things that spit off cash. Right. And you say, well, we could buy municipal bonds. We could buy any kind of bonds and have them mature every 3 months or 6 months or a year, whatever you need to cash in. That generates cash too, right? Those bonds come up and they get redeemed. We can sell other things if we own some stock and the valuations are right. And okay, we're going to sell some of those. And now you're getting back into, one of the advantages of building a diversified portfolio that's going to be smoother, so that you're not having to, if you have to draw money from that account, you're not having to draw it down during drawdowns. Let's say you're in an all U.S. stock portfolio, and it drops 30%, and you have to spend some money. You've got costs. Well, you're probably not going to reach those long-term return expectations if you're spending in drawdowns.
Yeah, the timing is everything, and that's a great point. If you need cash when the market's down, that's a really hard time to be selling.
Right. Conversely, if you're diversified, you have an opportunity now to sell the things that are up or that were flat, and buy your straw hats in the winter.
Right. I'm curious for. We spoke a little bit about the uncertainty with AI and the economy, and I think you and I had exchanged the recent Economist article on the economics of superintelligence. Any advice you'd have for a high school student, a college student entering the workforce in a few years, or preparing to enter the workforce in a few years? I had a conversation recently with a college student who was feeling like some of the rungs on the ladder that they were expecting for career opportunities weren't as visible and accessible. And I think that change is likely, going to accelerate in a lot of the fields of the knowledge economy. And just curious how your kids have launched. They're in their careers. So for maybe people starting in their careers or young in their careers, or for people who's thinking about careers in a few years, how best to prepare for the economy that you see ahead?
You know, before I try to tackle it, I I I wonder to some extent um, if maybe you and I and the circles we move in, uh, there are a lot. I would say they're probably dominated by knowledge workers, and I can't help but feel that we're more aware of this transition than we were of the transition from globalization, where a lot of blue collar jobs were lost. It's something I think about from time to time. It's real. Um, I I can just tell you what we've experienced at our firm, which was um, we started using these LLMs as soon as they were out, and kind of overnight we're in a position where we said, you know, little bit being a little bit flip, but we asked ourselves, how could we hire somebody under 30 anymore? I mean, the output that we were getting, the quality of it, the speed of it for whatever it is, a few $100s a month, um, it's real, right? And yeah, we can. There's some frightening scenarios. I think I'm not. I don't feel comfortable giving advice. In part because I think about all the advice that's been given that was wrong. Right, learn how to code. I probably should have been saying learn how to weld. You know, and then also, Peter, I think the speed of the change. I mean, I think about the very beginnings of this, and we did a fair amount of research on the power needs, and they're really hard to get your head around. And then you have something like DeepSeek, and you think, well, wait a minute, has that all of a sudden shifted? Are we now cutting those, depending upon what it can and can't do? Are we now cutting those estimates in half, by 2/3? It's early, and the only thing I can think is, you know, making sure that they know how to use these tools. Learning how to think, making sure that they know how to use these tools. There are certainly some professions that seem much more at risk. I think about in medicine, radiology, that seems very high risk. Now, if instead you are holding a scalpel, that seems lower risk to me. It's my more simple way of thinking about this. But yeah, it has the potential to be very disruptive. And one of the things I think about, comparing to other periods, right, to electricity, the railroads, printing press. The thing that feels different here, which, again, I'm just being a armchair philosopher, but is the speed.
Mm-hmm. Right.
Right. And that feels like it could be a very disruptive. But my kids range from 23 to 30, and I tell them to encourage them to use these tools to be better at what they're currently doing, and they all are, and it's very exciting to watch their own personal productivity grow with these tools.
Yeah, and it has significantly reshaped how we do our work here at Tiller. I think it's reshaping the economy. I've been looking at the history of farming as another one of many industries that went through change with mechanization, where we went from a third of our workforce working in agriculture to 2 or 3% working in agriculture. through mechanization. And again, you're right. The speed is different here. We've gone through shifts. Haven't gone through a shift like this with knowledge work per se, and it's a brave new world. So I think it's we're all trying to be nimble on our feet and use these tools to our best advantage. And I think that's also good advice. Stay curious and keep figuring out how to use these to our advantage.
Yes, I'm sure this has been your experience using them, but as you get into narrower and narrower areas where you have specialty, you start seeing more of the flaws.
Sure.
And the other thing I notice is just being a lot older. I'm able to catch things that it's just not right. And I think about somebody who's 25, and are they going to be more likely to accept that as it is? So, I tell my kids in particular, if you're working on something that, particularly if you don't have expertise in the area, you've got to keep going back and challenging it, challenging the LLM to make sure that, you're getting, somewhere close to the truth.
Yes. Yeah, they're incredibly good at consensus thinking. And to your point, someone who's early in their career, all their work at that point is getting to the point where they can develop and leverage consensus thinking. But a lot of the breakthroughs come with the thinking that's not consensus, the thinking that's orthogonal to it. And so that, I think that is knowing those differences and knowing where we can use them, and also where there might be real innovation that breaks through or is orthogonal to that consensus is important too.
It's interesting, isn't it, that you it's almost like having this friend who's really smart, which you call them, you call her smart, you're smart, and she's impressed you because of her speed and her ability to grab a lot of facts, broad facts across subjects. But the more you talk to her, the more you start asking questions like, like somebody who was smart would be able to handle that. A good example of this was I was having ChatGPT make some quizzes, and I was taking them, and regularly getting basic math wrong, really simple math. Also saying, things like, take this group of letters and then form, pick your choice of if I rearrange those and which word would come out of that. And I mean, they were just wrong. Those letters weren't in there, and you would press and say, oh, you're right. And I would ask, why are you not able to do this? I mean, this is real simple math. And the answer would be things like, well, sometimes I just work too fast. And so it is, it takes a while to get used to it, because your first interactions are, right, you're so impressed.
Yes. I asked ChatGPT recently, I said, tell me what you know about me and, my strengths and my weaknesses. And it came back with this incredibly thoughtful response that I took me aback. And I thought, oh, it's really paying attention. And I had a friend do the same thing and noticed that they came back with some similar observations, even though they're quite different, and then realized it's a bit like a figure eight ball or a tarot.
I was going to say numerology or the horoscopes or right. You say something that's general enough, you like animals, right? Well, yeah, there was an animal I liked once, and we're right.
Yeah, one of the gimme phrases is you're managing a lot. You have a lot on your plate right now. And I was like, yeah, I do. And then I think okay, that's true of everyone. So
Right.
That's useless.
Right.
Yeah. Thank you, Peter. This has been awesome. Thanks for sharing your thoughts, your wisdom, your perspective, and really, really appreciate this conversation.
Thank you, Peter. Good to see you.
Good to see you. That's all for this episode of Money Matters, Life Matters More. Peter, thank you for sharing your time and your wisdom with us today. My hope is that today's conversation gave you all a new perspective and practical ideas for your own journey. Because at the end of the day, money is a tool. And the more we engage with it, the more confidence we have to build the lives that matter most to us. Until next time, take care.